Welcome back and thank you for watching. Today we have another great accounting lesson for merchandising company journal entries. Now we're going to do these from both the seller and the buyer perspective. Now these can be a little bit difficult when you first start learning how to journalize these transactions, as they're a little different from what you normally will have learned during your first few months of accounting. So let's take a look at the transactions that we are going to be doing today, and then we'll jump right in. So we have two companies. We have Sal Company and we have Bowl Company. Now Sal Company is selling merchandise to Bowl Company, and they're giving us some additional information like these terms here, as well as the cost of the merchandise sold. In our second transaction, we are going to show how to account for this freight cost that Bowl is paying for. And then Bull is going to return some of the merchandise, and then Bull is going to eventually pay for the merchandise. So let's take a look at this first transaction. Sal Company is selling $4,000 of merchandise to Bull Company. Now, before we jump right in, let's take a look at these two different companies. Now, Sal Company is selling and Bull Company is buying. So in this case, Sal Company is our seller, and Bowl Company is our buyer. So let's take a look at this first transaction and kind of take a look at the different information, because there is a lot of information kind of jam-packed into this one transaction on May 3rd. So they tell us that it is 210 net 30 FOB shipping point. Now let's talk about what all those numbers and terms mean. Now 210, that tells us about the discount amount. So it's going to be a 2% discount if the buyer pays within 10 days. But regardless, the total amount is due within 30 days. So if this said 115 and 60, that would just be a 1% discount if paid within 15 days. Regardless, the total amount is due within 60 days. So that's how you read those terms. Now this next one, FOB shipping point, tells us who is responsible for paying shipping. So keep in mind here, shipping point means that the buyer is responsible. Now, if this said destination, then that would mean that the seller is responsible. There's several different terms or FOBs that we could have depending on the logistics contract. However, in this case, in introductory, we typically just see the two: shipping point, which means the buyer is responsible, and destination, which means the seller would be responsible. So this 210 net 30, we don't have to do anything with that now, nor do we have to do anything with the FOB shipping point. However, there is one other piece of information that we need to know. The cost of merchandise sold was $2,250. Now I have two amounts here, so we have to really consider what is going on here. When they say that Sal Company is selling $4,000 of merchandise to Bowl Company, that's the sales price. Now think of it from the buyer's perspective. Whenever you buy something, you do know the sales price. However, you do not know how much the company you're buying that merchandise from, how much they originally paid for it. So would the buyer really know anything about this $2,250? No, this is something that the buyer would not know about. So this is only going to be journalized from the seller's perspective, this second half here. So now that you have a little bit of an overview of what's going on, remember we're using the gross method today. So try pausing the video and journalizing these transactions, and then we'll go through each one together. Okay, let's start with May 3rd. And we're going to do it first from the seller's perspective, and then we'll go move over to the buyer's perspective. Now keep in mind we are using the gross method, which means that we do not account for discounts until the actual payment has been made. And we are also using the perpetual method of inventory valuation. So let's start with the buyer, May 3rd. Okay, and now let's analyze what's going on here. So Sal Company sells $4,000 of merchandise to Bull Company. So two things we need to record here. Now, since there's terms, that means that we're not getting paid now. We are going to be paid later. So think about that. What account do we use when we are going to be receiving money in the future? That would be accounts receivable. And now you should be fairly familiar with categorizing types of accounts and determining your debits and credits, but let's keep analyzing it using this little pregnant Elsie that we've been using. So accounts receivable is the right to receive future cash flows or the right to collect money from customers. So in this case, it is a future economic benefit, so it's an asset, or it's not in this case, it'll always be an asset, and it is going up. The amount that we are owed is going up, so that would be a debit to accounts receivable. Now, why do we have the right to record accounts receivable? What did the seller do? In this case, they actually earned some revenue. Now, keep in mind that for merchandising companies, they don't usually use fees earned or service income. They use sales. Sales is usually the revenue account that is used for all merchandising companies. Okay. Now, remember, we still have this other piece of information. The cost of merchandise sold was $2,250. We do have to take this into account as the buyer. Remember, we recorded some sales, but we also have to record what did we sell? Merchandise inventory. And that merchandise inventory that we sold is currently on our books at $2,250. That's how much we paid for it. So when we got it, we would have debited merchandise inventory for $2,250. Well, now we're selling it. So what's happening to merchandise inventory? That asset, it is going down. So that would be a credit to merchandise inventory. So let's go ahead and credit merchandise inventory for $2,250. And now let's think about our debit. Now for merchandising companies, whenever you're selling inventory using the perpetual system, you also have to record that cost of merchandise sold, which we started doing right here. So that means that this debit here is literally going to be an account called cost of merchandise sold. Some companies use cost of goods sold. So take a look at your 5 types of accounts and try thinking about what type of account would that be. Cost of merchandise sold, would that be an asset? No, you don't own the cost. Liabilities, nope, you don't owe anything. Is it capital? Not the owner's interest. Is it revenue? No, it's a cost, so that would be an expense, hence why we are debiting it here. Okay, now that we've done the seller's side, let's move over to the buyer's side. Now think of it from the buyer's perspective. What are they doing? They are ordering inventory. So what's happening to their merchandise inventory? That asset, it is going up. So that would be a debit to merchandise inventory. For $4,000. Keep in mind the buyer does not know about this $2,250. You don't know how much Amazon pays for the goods that you're receiving from them. So you have to keep in mind that the buyer would only know about this $4,000 sales price. Okay, and the second piece, if they're not paying now, well, they're paying later. So that would be accounts payable. Something we owe. Okay, and that's actually it for the buyer. So the buyer is generally a little bit easier than the seller would be. Okay, now let's take a look at May 4th. Bowl Company pays $200 to have the merchandise from the May 3rd purchase shipped to them. Okay, so this is a little bit of a tough one. You have to consider a few things here. One, who's paying, and who is responsible to pay for it. So in this case, we have to look back at the terms from May 3rd. So that is FOB shipping point. Now remember, who's responsible when it's FOB shipping point? That would be the buyer. So the buyer is responsible for paying, and the buyer is paying right now. So let's deal with the easiest part. Pays $200. So what happens when we pay $200? What are we giving up? That would be cash. What type of account is cash? An asset. So to decrease that asset, we credit cash. Okay, the second part of that, we have to record the freight. Now, if this were a seller paying for FOB destination, then it would be an expense. However, there's this very important rule where a buyer will always value its inventory at whatever it had to pay to get it to it in working condition. So in this case, when we see that $200 is for shipping for merchandise, that's actually not going to be an expense. We actually are going to increase the merchandise inventory account. It's a very important rule, and it's probably going to take a little bit of practice to remember that one. So remember, if it's FOB destination and the seller is paying, then it would be a delivery expense. However, if it is the buyer and it's FOB shipping point, in that case it would be an increase to merchandise inventory. Okay, now let's look at the seller's perspective. Does the seller know anything about this? Would they have to record anything? No. So for May 4th, the seller does not have an entry. It just applies to the buyer. Now, May 9th, Bolt Company returns $1,000 of merchandise, and the cost of the merchandise return was $560. So again, this first part, both parties know about, but the second one, only the seller knows about. So let's start with the seller. Now, when there has been a return, we have to record a few things. One, we have sales returns and allowances. You'll notice I'm debiting this one. And the reason is, let's write it out. And the reason is it's a contra revenue account. So that means it has the opposite balance of a regular revenue. So it would be this debit here, hence why we are debiting it. And also, so sales returns and allowances. Now let's take a look at accounts receivable. Accounts receivable, the amount that we are owed is going down. So we no longer are owed that $1,000 that the buyer is returning. Now for the second piece, we still have one more piece we have to record. We are receiving merchandise inventory, so our merchandise inventory is going to go back up for the amount returned, or the cost of the amount returned, which was $560. And our cost of merchandise sold is going to be going down for the cost of the amount returned. So notice these two kind of flip, but we'd use sales returns and allowances instead of sales, and these two definitely flip. So let's take a look at this next side. Over here for the buyer. So when we have a return, we have to record one thing only, and that's that $1,000 of merchandise that had been returned. So what's happening to accounts payable? Well, accounts payable is going down because they no longer owe that. And what's happening to their merchandise inventory? Well, that's going down as well because they're returning that. There we go. So you'll notice for the buyer, it is literally flipped when there's a return. Okay, let's take a look at this next one. This purchase. There we go. Okay, so now we're going to actually pay for the May 3rd purchase. So on the seller's perspective, what happens when we are being paid? Well, we are receiving cash, which would increase cash. And we are also going to have to decrease the amount that we were previously owed. So I'm going to actually move down here. I'm going to put in accounts receivable to decrease that accounts receivable we were previously owed. So let's think about what we were owed. Let's see what the balance in accounts receivable is. Well, we previously increased it by $400. However, remember there was this return here. So this return is going to decrease accounts receivable. So that means that there is a $3,000 decrease to accounts receivable. Now, how about for cash? Let's look at those terms. The purchase was on May 3rd. The payment was on May 13th. So they are actually doing it within 10 days, so they get a 2% discount. So let's think about that discount. I'm actually going to go to this line right here and talk about it. So they owed $3,000. However, the seller is being nice and giving them a nice 2% discount for paying early. So they are going to get a $60 discount. So how much cash is the seller actually receiving? Well, $3,000, the amount they were owed after the return, minus that discount. So the amount of cash is $2,940. So the last thing we have to do is to take care of that $60 discount. And that would actually go into sales discounts, and that is another contra revenue, hence why we are debiting it. Now let's look at it from the buyer's perspective. It's very similar actually. So the buyer is going to be paying cash. I'm going to go down to this third line and do it. Cash. How much cash are they paying? Well, we already determined they're paying $2,940. What's happening to accounts payable? Well, they're paying it off, and keep in mind it's just like it was on the seller side. We increased it for $4,000, decreased it for $1,000, so $3,000 is what they had previously owed. So where do we have to stick that $60 discount to make our debits and credits equal? Right here. And the last thing you have to remember is for the buyer, remember this is sales discounts, this is for the seller. For the buyer, the discount will be recorded under merchandise inventory, because remember we're only going to pay for it, record our merchandise inventory for whatever we pay for it. So we didn't pay $4,000 minus $1,000 like what's recorded here. We only paid $2,940, so we're decreasing it by that $60 discount. So keep practicing, and if you have any questions, make sure to leave it in the comment section below. In the meantime, happy studying.